Every single AI query you run tonight, every image generated, every search processed consumes silver, physical silver, right now. Not metaphorically, not theoretically, literally. The chips inside every AI data center contain silver, and they are running 24 hours a day. Meta, Microsoft, Amazon, Alphabet, they just committed $715 billion to AI infrastructure in one quarter. $715 billion building data centers that run on chips that are made with silver, your silver, right now. And here is what nobody has connected yet. That $715 billion creates a silver demand the market cannot physically supply. Stay with me, because the number I'm about to show you will make $715 billion look small, and it directly involves your silver position tonight. Bank of America already said $309 for silver in 2026. Tonight, I am going to show you why $715 billion makes that conservative. Conservative, not aggressive, not optimistic, conservative. Because the math behind AI silver demand runs in one direction only, and that direction is not down. And while retail investors are watching silver at $74 confused, JP Morgan and China are doing something very specific. Right now, simultaneously, two of the most powerful silver market participants in history, both positioning in the same direction at the same time while price sits at $74. Think about that. 3 loops, all connecting at one point. A convergence that the silver market has never seen before. And I am going to prove all 3 with data tonight. Not opinion, data. But before I do that, something happened 48 hours ago that changes the timeline on everything, and almost nobody caught it. Stay with me. Let me prove loop 1 first. AI consumes silver, not indirectly, directly. Through semiconductor manufacturing at a scale the market has never seen before. Here is how it works. Every advanced semiconductor chip, the kind powering AI, requires silver paste for electrical conductivity. No silver paste, no chip, no AI. Think of it like this. Imagine you are baking a cake. Flour is to cake what silver is to AI chips. You cannot substitute it, you cannot skip it. It must be there. The average AI server rack contains approximately 2.4 ounces of silver. One data center contains thousands of server racks. Meta alone plans 40 data centers times thousands of racks, times 2.4 ounces per rack. The math produces a number the silver market has never been asked to supply before, and this is just Meta. Microsoft is building 100 billion in data centers. Amazon another 100 billion, Alphabet 85 billion, all requiring silver, all now. But here's the detail that changes everything about Loop 1. Silver consumed in semiconductor manufacturing does not come back. It is destroyed in the process, permanently gone. Unlike gold, which gets recycled, silver in chips gets destroyed at the molecular level, consumed, gone. Every AI chip built permanently removes silver from global supply. So when Meta commits 150 billion to AI infrastructure, they are not just spending money. They are permanently removing silver from the available supply pool. Now multiply that by 4 companies, 715 billion total, all building simultaneously, all permanently consuming silver, all in 2026. The question Loop 1 asks is simple. Where does that silver come from? The answer is what makes this situation unlike anything the silver market has faced before. And that answer connects directly to Loop 2. Because the supply side of this equation is where the real story begins, and where the $309 math starts. Loop 2. 715 billion in AI spending creates silver demand that the market physically cannot supply. Here's the math. And the math is unambiguous. Global silver mine production in 2026 is approximately 820 million ounces annually. That is the entire world supply from every mine combined. Solar panels alone consume 250 million ounces. Electric vehicles consume another 80 million. Electronics and medical consume 160 million. That is already 490 million ounces consumed before AI data centers take a single ounce, leaving 330 million ounces available. Now add AI semiconductor demand from 715 billion in new data centers. Conservative estimates put additional silver demand at 150 million ounces, 150 million new ounces needed, 330 million available after existing demand. Sounds manageable. Until you add one more number, investment demand. As AI drives silver into the headlines, retail and institutional investors will add another 100 million ounces of demand conservatively. Minimum total demand, 490 plus 150 AI plus 100 investment equals 740 million ounces against 820 supply. That leaves 80 million ounces of surplus. Sounds fine. Until you remember the 6-year deficit has already removed 762 million ounces from above ground stocks. The buffer is gone. The surplus that should absorb demand shocks has already been consumed by 6 consecutive years of deficit. The margin for error is now essentially zero. When a market has zero margin for error and a new demand source the size of AI arrives simultaneously, the math produces one outcome: repricing, violent repricing. And that repricing has a mathematical floor. If demand exceeds supply by even 5%, and AI makes that likely, silver at $74 becomes untenable. Loop 3 shows you why China makes this certain. Loop 3. JP Morgan and China positioning simultaneously. This is the signal most retail investors are completely missing while watching silver at $74. Let me start with China, because China does not make investment decisions randomly. They make them based on intelligence and positioning timelines measured in decades. In March 2026 alone, China imported 836 tons of silver, 173% above the 10-year seasonal average. Think about that number, 173% above normal in a single month, while simultaneously classifying silver as a strategic national security material. Strategic national security material means China views silver the same way it views military hardware. You do not export it, you accumulate it. Aggressively, quietly. And here is the China AI connection that ties Loop 3 to Loop 1 and 2. China is not just buying silver for investment, they are buying it for their own AI build-out. China has its own $700 billion AI infrastructure program running parallel to the US build-out. 2 superpowers competing for the same silver supply simultaneously. Now add JP Morgan. The institution historically most associated with silver short positions has reportedly reversed its net position to long for the first time. When the entity most capable of suppressing silver price becomes a buyer, the structural ceiling created by that short position begins to dissolve. That is a category shift. China accumulating, JP Morgan reversing, AI demand arriving, all 3 forces activating simultaneously, while silver sits at $74. Draw your own conclusion. Now, something happened 48 hours ago that I promised you earlier, something that connects all 3. Loops to a specific date and a specific price level. I am going to show you that in the next section, but first I need you to understand the 5 patterns that make this the most important silver setup of 2026. Pattern 1. The $715 billion AI commitment and its direct mechanical relationship to silver price. This is where the data becomes undeniable. Let me put the numbers on the table. Meta committed $65 billion, Microsoft $100 billion, Amazon $105 billion, Alphabet $75 billion. 4 companies. $345 billion in confirmed AI capex for 2026 alone. That is not a forecast. That is committed capital already being deployed. Now the additional $370 billion comes from second-tier AI infrastructure, NVIDIA, AMD, TSMC expansions, and the hyperscaler supply chain build-out. $715 billion total, all requiring chips, all requiring silver. All being built in the same 24-month window, 2025 to 2027. Historical context. The entire semiconductor industry consumed approximately 90 million ounces of silver annually before the AI build-out began. 90 million. The AI build-out alone, at $715 billion, is expected to increase semiconductor silver consumption by 60 to 80% above that baseline. 60 to 80% increase. On top of 90 million base, that is 54 to 72 million additional ounces of silver demand annually, every year. And this demand does not plateau. Every new AI model requires more chips. Every chip requires silver. The demand curve bends upward, not sideways. Upward, permanently, because AI is not a cycle. It is a structural shift. The internet did not cycle back to pre-internet demand levels. AI will not cycle back to pre-AI semiconductor demand. This is pattern 1's core argument. AI creates permanent structural silver demand that grows year over year. The $715 billion is not the ceiling. It is the floor. Next year, the commitment will be larger. The year after, larger still. Because every company that falls behind in AI infrastructure is at existential competitive risk. And here is where pattern 1 connects to the price. Permanent structural demand growth against a supply that cannot grow at the same pace produces one outcome: higher price. Silver mines take 7 to 10 years to bring online from discovery. No new significant silver deposits have been found recently. Supply cannot respond to demand at this speed. Supply is structurally constrained. Demand is structurally growing. Time resolves that equation through price. And the price required to balance this equation is not $74. Pattern 1 tells you the direction. Pattern 2 tells you the magnitude. And the magnitude is where Bank of America's $309 target comes from. Pattern 2. The full industrial demand picture. because AI is not arriving into a silver market with excess supply. It is arriving into a market already at structural deficit. 6 consecutive years of deficit. Since 2021, the world has consumed more silver than it has produced every single year, not once, not twice. 6 consecutive years. 762 million ounces have permanently left above ground silver stocks since this deficit cycle began. That metal is not coming back. It is gone forever. Now let me show you where that silver went, because understanding the demand composition tells you why AI arriving now is so structurally significant for price. Solar panels. The global solar installation target requires 250 million ounces of silver annually by 2027, up from 130 million in 2022. That is a 92% increase in solar silver demand in 5 years, while mine supply grew less than 3% over the same period. The math was already broken. Electric vehicles. Each EV contains approximately 1 ounce of silver. Global EV production is targeting 40 million vehicles annually by 2027, 40 million ounces. Medical technology. Silver is irreplaceable in wound care, surgical instruments, and antimicrobial applications. Demand growing 8% annually with no substitution possible. Electronics, smartphones, tablets, laptops. Every device contains silver contacts and connectors. Global device shipments increasing as emerging market penetration accelerates. Now, stack AI on top of all of this. Not instead of, on top of. All existing demand continues growing. AI demand arrives as an additional layer. Simultaneously. The silver market was already running a structural deficit before AI arrived. Now, the largest industrial technology deployment in human history is adding to that deficit today. Pattern 2 tells you the deficit was already breaking the market. Pattern 3 tells you the exact price required to rebalance it, and that price is $309. Pattern 3. The math behind $309. This is not a random number. It is not a prediction. It is the output of a specific mathematical relationship. Bank of America did not guess 309. Their head of metals research, Michael Widmer, derived it from the gold-silver ratio under monetary stress conditions. Here's how the math works. Gold is currently trading at approximately $4,700 per ounce. The gold-silver ratio sits at 63 to 1. 63 to 1 means gold is 63 times more expensive than silver right now. Historically, that ratio compresses dramatically during precious metals bull markets. In 2011, the ratio compressed to 32 to 1. If gold stays at 4,700 and ratio returns to 32, silver mathematically reaches $147. $147 from ratio compression alone, without AI demand, without the 6-year deficit, without China accumulation, just ratio compression. That is the floor. Now the ceiling. In 1980, during the Hunt brothers squeeze, the ratio hit 14 to 1. If gold reaches 5,000 and ratio hits 14, silver hits 357. Bank of America used a ratio of 15.2 to 1 with gold at 4,700. The output is $309, their exact published figure. 309 is not aggressive. It assumes a ratio that has already been seen once in modern silver market history, in 1980, under similar structural conditions. But here's what Bank of America's math did not include: the AI demand variable, because the 715 billion commitment came after their target was published. If you add AI-driven industrial demand to the ratio compression math, the output exceeds 309, possibly significantly. The math runs higher, not lower. Pattern 3, conclusion. 309 is the conservative case. With AI demand included, it becomes the floor, not the ceiling. This is what the arithmetic actually says. Pattern 4. The connection between AI spending and COMEX physical silver stress. This is the pattern nobody in the financial media has connected yet, until tonight. COMEX registered silver, the physical metal available for immediate delivery, currently sits at approximately 77 million ounces, down 85% since 2020, 85% drawdown in registered inventory, while global AI infrastructure spending was growing from 0 to 715 billion. These are not unrelated trends. Here is the connection. AI manufacturers need silver now, not in futures, not in contracts. Physical silver delivered to fabricators immediately. That is COMEX registered inventory. As AI demand accelerated, industrial buyers began pulling physical silver from COMEX directly, bypassing the paper market, going straight to the source, hence the 85% drawdown. Think of COMEX registered inventory as a warehouse. For decades, manufacturers could always find silver there. Now the warehouse is 85% empty, and the orders are growing. When a warehouse runs low, the price of what is inside goes up. Basic supply and demand. COMEX registered silver at 77 million ounces is the warehouse running critically low. And now, $715 billion in new AI infrastructure is sending more orders to that warehouse simultaneously. The arithmetic of that situation is not complicated. Pattern 4 tells you the AI spending is not future demand. It is current demand already hitting physical silver markets. The COMEX drawdown is the evidence, already visible. And there is something happening at COMEX right now that I need to show you in Pattern 5, because it directly connects China and JP Morgan to the AI narrative tonight. Pattern 5, the China and JP Morgan positioning signal. And why these two actors moving simultaneously tells you more than any price chart ever could. Let me start with what China actually did, not what analysts think China did. What the import data actually shows, because the numbers are extraordinary. March 2026. 836 tons imported in a single month, 173% above the 10-year seasonal average. Verified data. But here's what most analysts missed about that number. China's import surge coincided exactly with their domestic AI infrastructure announcement. The timing is not coincidental. China announced a domestic AI build-out equivalent to $700 billion over 3 years. They need silver for chips. They moved immediately to secure supply. And they moved before the price reflected the demand, because that is how China operates in strategic commodities. They position years before the market prices in the reality. They did this with rare earth elements in 2010. They did this with lithium in 2015. They are doing it with silver now. Same playbook, same timing. Now JP Morgan, a prominent precious metals analyst with institutional connections, reported JP Morgan has reversed its net silver position from short to long in size. JP Morgan understands AI infrastructure demand for silver better than any institution on the planet. They finance the technology companies making the $715 billion commitment. When your bank finances Meta's AI build-out, you know exactly how much silver Meta needs to buy. And you position accordingly before that demand hits the open market. China positioning for AI silver supply security. JP Morgan positioning with knowledge of AI silver demand, both moving simultaneously, before the price reflects the reality. Pattern 5 conclusion. The two most sophisticated silver market participants in the world are both positioned long at $74. That is not a coincidence. That is a signal. 5 patterns, all pointing the same direction, all connected to the same underlying reality. AI is creating a silver demand shock the market cannot absorb at current prices. Now, I promised you something. 48 hours ago happened that changes the timeline. That event is about to become very public, and it connects directly to the May 5th earnings date. Silver mining companies begin reporting Q1 earnings on May 5th, 4 days from now. Those reports will contain a data point that changes how institutions see silver permanently. Q1 2026 recorded the highest average silver price in the history of precious metals futures markets. Not in recent memory, in all of recorded history. Full stop. But the data point inside those earnings that matters most is not the revenue number. It is something else entirely, something the market has not yet priced in at all. I am going to show you exactly what that data point is and why it will force institutional fund managers to reassess their silver price targets within days of May 5th. But first, let me give you the complete monetary framework, because without understanding the macro layer beneath all 5 patterns, the full picture remains incomplete tonight. The monetary framework is what transforms this from a silver story into something categorically larger, and it is where the $309 math becomes inevitable. Stay with me through this next section, because this is where most silver analysts stop short, and where the real structural argument for 309 actually lives. Something is simultaneously unfolding on the equity side of this story that I will bring back to in 15 minutes, and it is about to become very public, very fast. The monetary framework. This is the layer that makes everything else structurally inevitable. Not possible, not likely, structurally inevitable. The arithmetic runs one way. The United States carries $40 trillion of national debt. Every 1% increase in average interest rates costs $400 billion of additional annual expense. The current annual interest burden has already reached $1.3 trillion, consuming 25% of all federal tax revenue before a single program is funded. Now here is where it connects to AI and silver. The Federal Reserve's only mathematically viable long-term path is rate reduction, because the debt arithmetic demands it. If rates rise to 12%, historically not even the ceiling reached in the 1980s, annual debt service reaches $5 trillion, equal to all tax receipts, 100% of federal income consumed by interest alone, nothing for defense. Nothing for social programs, nothing for anything. That scenario cannot occur politically, which means rates get managed lower, not because inflation is conquered, but because the arithmetic of 40 trillion in debt leaves no other viable path. This is not opinion, it is accounting. When rates go lower, the dollar weakens. When the dollar weakens, assets priced in dollars reprice upward to maintain real value. This is not theory, it is the mechanism. Silver at $74 tonight is priced against a monetary backdrop arithmetically committed to producing a weaker dollar. The tension between those two realities cannot hold indefinitely. Now add $715 billion in AI spending creating structural silver demand. Add the 6-year deficit removing 762 million ounces from supply. Add China accumulating at record pace for AI supply security. Add JP Morgan reversing its historic short position. Add Bank of America publishing a $309 target. 5 forces plus the monetary framework, all pointing at silver price, all operating simultaneously, all on the same timeline. The math does not require your belief, it runs regardless. Now I want to be honest about the risks, because any analysis that ignores downside risks is not analysis. It is advocacy, and this channel does analysis, not advocacy. Risk 1. If the Iran ceasefire holds and Hormuz reopens permanently, oil prices fall. Inflation drops faster than debt math requires. The Fed gains breathing room. The dollar strengthens. In that scenario, silver faces dollar strength headwinds. The AI demand story remains intact, but the monetary tailwind weakens. Timing of the repricing extends. This risk is real. Risk 2. If AI semiconductor demand proves less silver intensive than current estimates, because manufacturers find ways to reduce silver content per chip, demand growth slows. This risk is lower probability. Silver in semiconductors is not easily substituted. The physics of electrical conductivity makes silver difficult to replace, but the risk exists. Risk 3. If the Federal Reserve surprises with rate hikes rather than cuts, as some traders are now pricing, dollar strength crushes silver price timing. These 3 risks are real. I am not dismissing them. Anyone could delay the repricing event. But here is what none of them can change: the structural reality of this market. AI silver demand does not disappear if Iran makes peace. The 6-year deficit does not reverse if rates stay higher. China does not return its strategic silver reserves. Those are permanent. The risks affect timing. They do not affect destination. Silver at $74 is structurally mispriced against the forces building in this market. The only variable is when. Now let me show you the historical parallel that tells us how this resolves, because we have seen this exact setup before. Not approximately, exactly. 1980. The Hunt brothers attempted to corner the silver market. Before they did, the structural setup looked remarkably similar to tonight. In 1979, silver was trading at $6 per ounce. COMEX inventory was declining. Industrial demand was growing from a new technology wave. New technology wave driving industrial silver demand. COMEX inventory declining. Geopolitical uncertainty. Monetary system under stress from inflation. Sound familiar tonight? Silver moved from $6 to $50 in 14 months. 833%, triggered by one additional catalyst. One additional catalyst on top of the structural setup produced 833% in 14 months. We have 5 catalysts tonight, not one. Now 2011, silver moved from $18 to $48 in 8 months. 267%, triggered by quantitative easing and dollar weakness. Tonight we have multiple catalysts: AI demand, supply deficit, China accumulation, institutional positioning, monetary pressure. The question is not whether silver moves. The question is how aggressively. The historical pattern is not arguable. Structural silver setups with multiple simultaneous catalysts resolve with aggressive repricing. Always. This is why Bank of America called 309 conservative, because their model assumes cyclical demand. The structural reality runs higher. Now let me show you the specific triggers I am watching, because knowing what to watch in real time matters more than theory. 3 specific triggers. Watch these. When 2 fire together, the setup converts from building to executing. Trigger 1, silver mining earnings revealing physical premiums above spot price. Trigger 2, COMEX inventory falling below critical levels. Trigger 3, Federal Reserve signaling accommodation. When institutional investors see physical silver trading above paper price, they reprice immediately. Capital flows follow within hours. This is the timeline, not months, weeks. The triggers are already partially active. Now let me ask you something directly. Are you tracking these signals right now? Because what happens next tells you everything. Now let me explain the 2 paths this repricing can take. Path 1, orderly repricing, gradual movement, step by step. Path 2, disorderly repricing, fast moves, violent gaps, no time to react. In previous events, silver moved rapidly when catalysts aligned. Today we have more catalysts than ever before. Institutional money positions before the move. Retail reacts after. That pattern never changes. Which side you are on when the move begins is the only thing you control. Now here's the complete picture. AI demand is permanent. Supply deficit is real. Institutions are positioning. Monetary pressure is building. 7 signals, 1 direction, 1 convergence point. The question is not whether this happens. The question is timing. Most people will wait for confirmation. By the time confirmation comes, the move is already done. The signals are already visible. Now I want your view. Do you think silver is already priced correctly? Or is the market ignoring what is happening? Give me your number. Where does silver go next? Because the arithmetic is running, the triggers are approaching, and what you do before confirmation is the only variable you control. Before you leave tonight, one final connection that ties everything together. The 1980 parallel runs deeper than most realize. The Hunt brothers did not create the silver move. They triggered it. The structural setup existed before they arrived. Their delivery demand was the catalyst, not the cause. Tonight, AI is not the cause of the silver repricing. The structural cause is 6 years of deficit removing the supply buffer. AI is the catalyst entering a structure that is already built. The Hunt brothers moved silver from 6 to 50, 800%, from a setup with far fewer catalysts than today. The math of multiple catalysts today is instructive. The next video on this channel walks through that historical setup step by step and maps it directly onto the current structure. That comparison will change how you read the silver market. When you see the overlay, you will understand why major institutions chose aggressive price targets, and why the current structure suggests those targets may be conservative. That video is already on this channel. Watch it after this one. Together, they form one complete analytical picture of what is building right now. Subscribe and turn notifications on, because the upcoming earnings data will go live within hours of release. You need to see that data before institutions reprice. That update will reveal whether physical silver is trading above paper price in institutional markets, and how capital reacts in real time. The window where this setup is background noise is closing. Visibility is about to change permanently. Share this video with one person tracking precious metals before the window closes. Now let me give you the exact data sources used tonight, because transparency separates analysis from noise. AI spending commitments are publicly reported in company earnings calls. COMEX inventory is published daily. China import data is publicly released. Institutional forecasts are published through financial research channels. The deficit data is publicly available. Every number has a source. I am not asking you to trust. I am asking you to verify independently. Now something more important than any single data point, a framework for thinking about silver in the AI era. Silver has always had 2 demand drivers, industrial and monetary. Historically, these move separately. AI changes that relationship, because it drives both at the same time. AI infrastructure creates industrial demand for silver. AI-driven economic shifts increase monetary demand. Both forces now operate together. This is the structural shift most analysts have not fully incorporated. AI is not just industrial demand, it is total demand expansion. Every dollar of AI spending creates industrial demand. Every monetary response to AI disruption creates investment demand. This is why existing price models are conservative. The real demand profile is larger. The key takeaway is simple. The demand shift is permanent. Even if risks materialize, the demand does not reverse. The infrastructure is already being built. The silver is already being consumed. This is what makes the current cycle different from previous ones. Past cycles were cyclical. This is structural, understanding that difference changes how you position over months versus years. The near-term case is one move. The structural case is a transformation. Most people will wait for confirmation. By the time confirmation arrives, the majority of the move is already complete. Now I want your view. Is silver already priced correctly, or is the market ignoring what is happening? Give your number. Where does silver go next? Because the arithmetic is running, the triggers are approaching. Now let me explain the 2 possible paths forward. An orderly move happens gradually, step by step. A disorderly move happens fast, with gaps, no time to react. History shows that when multiple forces align, moves happen quickly. Institutional money positions first. Retail reacts later. Which side you are on when the move begins is the only thing you control. Now here is the full picture. AI demand is permanent, supply is constrained, institutions are positioning, monetary pressure is building, multiple signals, one direction, one convergence point. The question is timing, most will wait, few will act early. Now let me leave you with one final thought. Why silver and not gold? Gold is purely monetary. Silver is both monetary and industrial. That dual nature makes silver more volatile, but also more explosive in acceleration phases. In past cycles, silver amplified gold significantly. Today, both monetary and industrial forces are strengthening simultaneously. This has not happened at this scale in decades. This is why the current structure is different. The arithmetic is clear, the forces are real, the timeline is compressing. What you do with this information is the only variable left. Stay with this community, because the next data update will confirm whether the structure is transitioning into execution. I will be here, tracking the data, publishing updates. Subscribe, turn notifications on. Share this with someone who needs to understand what is building. The market will not wait for retail investors. It never has. The arithmetic is already running. Now watch the historical breakdown video on this channel. That alongside this analysis forms a complete picture of what is happening. Understanding the past is key to understanding what is coming next. The AI era is transforming silver from a cyclical trade into a structural position. Every AI system built consumes silver. Every expansion wave increases demand. This is not the end of demand. It is the beginning. This is why current pricing is disconnected from structural reality. The institutions see it. They are positioning early. You have now seen it. What you do next is your decision. The arithmetic does not require belief. It runs regardless. Stay informed, stay positioned, stay ahead of the move. I will see you in the next update.